Good afternoon, everybody. Thank you for joining us for Genscape's Winter 2015-2016 Natural Gas Market Outlook. We want to go ahead and give folks that are just signing in just a minute or two to get fully logged on, and then we will go ahead and begin. So please bear with us for just a minute or two. Thanks. Okay, we're going to give it just one more minute and then we'll get underway. Okay, we're going to go ahead and get started. Thank you for joining us. My name is Rick Margolin. I'm a senior analyst with Genscape's Natural Gas Group and going to be joined today by Randall Collum, who is Managing Director from our Spring Rock Production Group. He's Managing Director for Supply Side Analytics. And we want to give you our outlook for this winter's natural gas market and into the following summer season. You can see the agenda for today very quickly. We want to give you a quick snapshot of where lower 48 gas storage stands at present and where we think that lower 48 storage inventories will end on October 31st as we head into the winter season. We'll use this value to do our supply-demand balances and give you, ultimately at the end of the presentation, our estimation for where we expect storage inventories to end winter 15-16. Following that, we want to dive into the supply side, and Randall is going to talk about what is occurring with lower 48 natural gas production, talk about Spring Rock expectations and risks to our forecasts. We'll also talk about some of the changes that are occurring with infrastructure developments, primarily in the Northeast, and what implications those will have for production as well as basis prices throughout the lower 48. We'll round out the supply story by talking about our expectations for what the U.S. will import from Canada this winter, and we don't want to ignore LNG. LNG imports will still continue to be a factor on the supply side of the market this winter. Following that, we're going to look at what is happening in the demand sector. We'll look at our expectations for demand in residential, commercial, industrial power sector on the whole. And then we'll talk about what the U.S. has been and will be sending to Mexico both this winter, and we want to give you a little bit of a longer-term perspective as well. We've got some new data sets that we think are very exciting and provide market participants better understanding of what is happening with exports to Mexico on a timely basis. And we also want to talk about the first LNG exports from the United States into the global market. There again, we've got some data sets that we think can give our clients some unique perspectives and real-time data that can help with your own balances for the market. Then wrapping that up, we'll bring the supply and demand expectations together to give you our expectations for where lower 48 storage will end the winter season. So with that, let me give a brief outlook for lower 48 storage inventories. As participants from our last seasonal outlook for summer 15 recall, heading into the summer, we expected that continued supply growth, primarily from production, coupled with demand growing but not quite growing at a rate fast enough to keep pace with the supply growth, created the very real potential for us to test storage inventory limits, potentially see dollar handles on gas prices here in the back end of the summer. And it looks like we are, in fact, realizing that very scenario. Following the release of today's storage number, and then adding in our supply and demand forecasts for the next 4 storage weeks, at Genscape, we are expecting that there's a very real potential we end the injection season, we end the summer on October 31st with storage inventories in excess of 4 TCF, which could establish a new record for gas in storage in the lower 48. It's also very important to note that although the summer trading season ends October 31st, we do still see the likelihood that injections remain well into November, possibly as occurring well into December. So at present, we're not expecting our first net withdrawals based on current weather forecasts and supply and demand balances until we get into December. So we're looking at a lot of gas in storage heading into the winter, and that raises very real questions as to how supply and demand are met as we move into that. So with that, let's go ahead and talk about the supply side. And I'd like to, at this point, turn it over to Randall Collum, our Managing Director for Supply Analytics. Randall?
Hey, thanks a lot for that, Rick. Like Rick said, my name is Randall Collum. I handle all our production analysis here at Genscape. And right now I want to talk about our supply outlook for this winter. As of now, we actually think this winter is lining up to be one of the most volatile potential production scenarios that we've seen in the winter in quite a while, and we think that's highly tied to the Northeast production and all the constrained wells and the deferred inventory that have built up there. We actually think there's been another 250 wells added to the deferred inventory just this year alone between the Utica and Marcellus. As producers are dealing with low prices, they do not want to bring those wells online, and they also currently have more than a BCF a day of actual production shut in. We believe prices in the area, as long as they stay below $1.50, you'll continue to see production shut in. But as winter hits, demand hits, prices rebound, you could see daily volatile swings in production. We think you could see swings as much as 2 BCF a day on a day-on-day basis this winter, just depending on what producers decide to do with their production. Right now, this winter, we're calling for more than 2 BCF a day of growth in the Northeast. We believe that could be as much as a B to a B and a half higher than that, like we said, due to that deferred inventory and constrained production and price-related shut-ins. Companies such as Chesapeake and others, Cabot, National Fuel Gas, they have all said they plan to stay shut in for the foreseeable future. As of now, we believe they'll bring most of that BCF a day back online in December when prices at Dominion South bounce back up above that $1.50 level. However, on the other side of things, at current prices for next year, we don't believe they will bring on much of that deferred inventory. We think they're waiting for better pricing to do that. So we do believe there will be some spare capacity in all the new capacity that's being built out that should come on by November. But producers could fill that if they want to. The only other areas we believe that there will be growth in production over the winter will be the Permian Basin, where efficiencies have continued to improve. We believe they're on order of about 70% up year on year for this year. We believe that will be followed by another 35% of growth next year. So we'll see about 300 million a day year on year growth in the Permian. And then the Gulf of Mexico will have another 300 million or so of growth this winter, and that's mainly due to Delta House deepwater field that started up this year by LLOG, and the Lucius Hadrian South field, which we've seen hit as high as 575 million a day of new production over the summer. The rest of the areas in the U.S. will continue to decline. South Texas will be on decline. We believe it's already on decline. East Texas will continue its decline. The Mid-Continent declines will get bigger than they were last year, and the Gulf Coast will stay slightly down. The Haynesville continues to stay relatively flat, as we've seen Chesapeake grow their production there with more rigs, and we've actually seen Anadarko go from 0 rigs earlier this year to running 3 rigs currently in that basin. So you can see right here on this slide that we're calling for about 0.8 BCF a day of year-on-year growth in the overall lower 48 on this left graph here. Basically, production has been relatively flat since earlier this year. We believe production will peak this winter when all the price-related shut-ins are brought online from the Northeast, and then the associated gas declines that we are already seeing will continue to decline and take over that, and we'll see year-on-year declines, we believe, next summer. But this winter will still be up year on year. And like I said earlier, if prices and demand are there in the Northeast, we believe that could be as much as at least a BCF a day higher than that, highly dependent on producer behavior. We've been looking at this for the last 10 years, and we've never seen an instance like it is now where things are so heavily dependent on what a producer decides to do day to day. If you look at last September and October of 2014, we saw producers swinging their production on a daily basis depending on what demand and prices did. We saw Southwestern Energy come out and talk about that in their call last October, and we potentially see that happening again this winter. I will now pass it back over to Rick, and at the end of the presentation, if you have any more questions on production, I'll answer those.
Okay, so one of those things that's facilitating that production growth is, in small part, expansion of takeaway capacity from previously constrained areas, primarily in the Northeast. That's where we're going to see some of the most aggressive expansions and new builds. And as you can see on this map here, some of these have actually already come into service in the market. We know that REX is already flowing east to west, volumes from the Marcellus Utica out into the Midwestern market. TECO has brought on a couple of its projects already. A little bit more expansions come in from the Transco Leidy Southeast service, as well as Niagara expansion. Also, as you can see with the Utica Ohio River system gathering, there's more expansion to be added to the upstream production side. Now, one of the things we do want to point out here is that from a fundamental basis, these projects should generally be supportive of basis within the Northeast region. For those that track the Northeast pretty closely, you know that basis prices there have been very suppressed for a couple years as the production growth has more or less been stranded and had limited ability to get out to markets. Again, from a fundamental perspective, these projects should be pretty supportive. However, one of the things that we do want to point out to our clients is that we should temper expectations with regards to how much basis uplift these projects will provide. And that's really for a couple of reasons. One, as you can see on the left, some of these projects are moving gas out of Marcellus Utica into the Midwest. That's really a market where we have some serious questions about demand growth. And so when we look at weather-adjusted demand in that market, we're just not seeing the same kind of level shifts upward that I'll talk about here in a bit. Yes, there is good potential for demand growth there because the power stack is pretty well supplied by coal, but it's a different kind of coal. It's Powder River Basin and Illinois Basin coal that's generally cheaper and cleaner to consume than things like Appalachian coal. The coal fleet's a little bit younger. Also, there's pretty aggressive renewables growth within the MISO service area that does take some of the load potential away from natural gas. So while we are seeing some growth in gas demand within the Midwestern market, it's not nearly as aggressive as we see in other markets. And so the question becomes, if you're moving incremental new volumes into that market, what has to happen in order to make that occur? And really the way to do that is to price those new volumes in a way that displaces incumbent supplies. By incumbent supplies, we're talking about gas from the Mid-Con, from the Rockies, and from ACO, all of which are production basins that are facing their own price pressures. So again, while we do expect some basis uplift on the upstream side in the Marcellus and Utica from these expansion projects, some of that uplift is going to be muted by the fact that those gas molecules are going to have to be priced aggressively enough to displace incumbent supplies from those markets. The other thing we want to point out is that some of these systems have already been flowing, and it's very possible that the pricing behavior is already priced into those. For example, we've been notifying our clients for basically since the summer of 13 that Transco has already had the ability to flow gas north to south. You can see that in our pipe balances that we provide in our basis reports. You can also see that track the price spread between Transco Zone 5 and Zone 6, where Zone 5 oftentimes trades at a premium to Zone 6 in the summertime, enabling gas volumes to flow north to south. They've been able to do this without compression installed by simply taking advantage of pressure differentials at Leidy. Now that they will have compression installed, we can see those flows take place on firm contracted basis, but some of that has already been baked into the market. So it's very important to note that there may not necessarily be some huge price basis uplift as one may expect. So that's rounding out the production side of the story. Rounding out the supply equation on the whole, we need to talk about what we import from Canada as well as LNG imports. And as you can see on the left, at Genscape, we are expecting that this winter the U.S. will import 1.1 BCF per day less than we did last winter. Imports the last 2 winters were really rather strong for 2 reasons. One, because as you can see in the lower right, Western Canadian production was rather robust. It reversed some years of decline trends, and obviously winter 13-14 was a very strong demand winter for Western Canada, but last winter there was a bit of a regression in Western Canadian demand at the same time that production there was strong. So Western Canada was sitting on a pretty hefty surplus of gas that it was able to price to move into the lower 48 market. We don't think that that's going to, that trend of the last 2 years is going to be sustained. We actually think we're going to revert to the trend that we saw in the previous 6 years, where the U.S. imports less gas, because the balances in Canada get slightly tighter with production falling, as you can see in Spring Rock's forecast in the lower right, and B, by virtue of the fact that Western Canadian gas is just somewhat at a price disadvantage when having to compete for market share against Marcellus Utica gas into markets like the U.S. Northeast and coming here in the next few years into the Midwest. At the same time, I should also point out that Western Canadian demand growth has been rather impressive. Looking into the future, we do expect growth to continue, not quite as aggressively as it has in the past few years, but there should be at least another year or two of sustained growth in Western Canadian demand that allows Western Canadian molecules to stay back and meet demand within Canada. So overall, 1.1 BCF per day less that we import from Canada. Okay. And then rounding out the supply situation is gas that we import from the global market via LNG. Last winter, we saw some volumes come into the New England market that we haven't seen in 3 or 4 winters. One of the things I want to point out here is that Genscape now offers 3 different products for our clients to keep a really close real-time track on what we import via LNG. In the upper left, you can see a screenshot from a company we acquired called Vessel Tracker. Vessel Tracker provides real-time information as to where waterborne cargoes are at any given moment, including LNG cargoes. So this is a snapshot of the LNG vessel Matthew last February. There were a lot of questions as that vessel was circling around Trinidad, Tobago, and the Bahamas there. Questions about where this vessel was going to go. You could use our products to see in real time where it was moving to. To the right of that, you can see a screenshot from another one of our companies called Commodity Vectors. What Commodity Vectors does is it takes Vessel Tracker real-time ship location data and then looks at the history of behavior for a specific vessel as well as price signals from the market to give you a prediction of where a seaborne vessel is going to head towards. So we were able to use these 2 tools together to give our clients a heads up as to when a vessel was going to be targeting a specific market, in this case New England, before the vessel showed up. And so if you're trading New England or the Northeast, these are definitely tools that you're going to want to have access to in order to help with your supply and demand balances. And then in the lower left, you'll see a screenshot of images that we take at the Everett LNG terminal. So not only can we tell you when we expect a vessel to show up in the New England market, but as many of you that track that market know, not all of the LNG that gets sent out into the market is visible via pipeline nominations. There's a substantial portion of LNG that gets sent into the New England market via truck. And so what we've done is we've installed monitors at the truck depot to count how many trucks are leaving on a given time frame. We know what the volumes are on those trucks. And so that's really critical information if you're looking at trying to keep a really close, timely tab on the balance of that market. But all of these tools together have really given us an indication that LNG is going to show up. And then in the lower right corner, we've basically been given one more signal that LNG will show up this winter by looking at the prices in the global market. And what this is saying is that this summer, if you're a global LNG supplier, really the best forward market you could sell into has been Algonquin. And so it's for that, and as well as for contracted volumes that we know are slated to occur, that we think that LNG is going to show up once again into this market this winter. So having talked about the supply side, let's flip the conversation over to what is happening with all this supply on the demand front. And on the demand front, what you can see is that the last several winters have shown very steady upward growth. In the solid bars, what you can see is the actual non-weather adjusted demand values that we've had. And obviously the last 2 winters saw very robust demand because both winters were relatively cold in the context of the last 10 years, and in the case of winter 13-14 in the last 60 years. So we did have very strong demand because weather was really cold. But that's not the end of the story. As you can see on the semi-shaded portions of the bars from the last couple of winters, what you can see there is the weather-adjusted demand. So this is what demand looks like under quote-unquote 10-year normal weather conditions. And even here we see that demand per degree was continuing to show a steady upward increase over the last couple of winters. Now, this is really for 2 primary reasons. One is because we know that there continue to be additions to the rescon sector. We know that in the Northeast, there are utility companies that continue to expand their distribution networks to reach customers that were formerly burning fuel oil or propane. We know that there's been rural additions throughout the rest of the country where consumers are being added. In the Southeast, we know that new home construction is featuring gas forced air, i.e. furnaces. This is really important because that should be regarded as new incremental demand. That's not a new source of demand that destroys an incumbent source. In places like the Southeast and the desert Southwest, you have a lot of heating loads that are met by electric baseboard, which shows up in the power stack. But just by virtue of new home construction featuring furnaces, you're not necessarily taking away those baseboards. You can't retrofit houses to put in gas forced air in place of electric baseboard. So gas forced air in new home construction in places where we're seeing population growth is really should be regarded as a new incremental source of demand. At the same time, there is the second source of growth in these winter burn per degree numbers has been the power sector. Not only are we seeing population migration to areas like the South where there is a lot of electric baseboard heating, but we know that the winter market, just like the summer market, has been experiencing coal to gas switching. Coal to gas switching coming from either price pressures from gas being able to price coal out of the stack, but also from the slate of retirements in the coal sector that we've had the last couple of years from environmental regulations as well as cost concerns of an aging coal fleet. So that together feeds into our forecast. We do expect that this trend will continue this winter. As you can see in winter 15-16, this is our expectation for demand under 10-year normal weather conditions. And basically what we're saying here is that if weather this winter comes in at 10-year normals, we should expect to see about 91 BCF per day of demand. That's pretty close to what we saw in actuality last winter on a non-weather adjusted basis. And remember, last winter was relatively cold. So that's really taking into account that structural upward growth that has been occurring in the market the last couple of years. Now, what happens if this winter is on the colder end of things? Well, what we did here is we forecasted what demand would be if we get a repeat of winter 13-14, which was a record cold winter. And if that's the case, then we're looking at demand coming in about 93 BCF per day, which would be about 1.4 BCF per day above where demand came in last winter. Also very important to note that with that structural growth that I was talking about, the same temperatures that we saw in winter 13-14, if those occurred this winter, would generate about 1.7 BCF per day more demand this winter than we had in winter 13-14. So very impressive growth numbers. That said, most meteorologists are not expecting this repeat of conditions. There's pretty much near unanimity that we are facing an El Nino type winter. And what that really means is that for the southern states, you could potentially see slightly below normal temperatures, so slightly colder than normal. The middle third of the country should see temperatures at normal to slightly above normal. And the top third of the country should expect to see above normal temperatures, so warmer than usual, which would potentially suppress or kind of wipe out some demand. So to get a sense of what demand would look like under these El Nino conditions, we looked back to temperatures at winter 97-98, which was the last strong El Nino year, and we actually saw that those temperatures were slightly colder than what we saw in winter 11-12. So for this projection of warm demand scenario, we used temperatures from winter 11-12, and what we see is that demand should come in at about 87 BCF per day, which would be 4.5 BCF per day lower than last winter. That said, again, taking into account this structural growth that we've been seeing, that would generate about 8 BCF per day more than what we saw in winter 11-12. So as we've moved through time and added more structural demand growth, a repeat of winter 11-12 temperatures would still generate 8 BCF per day more demand than we saw in that winter 11-12, but it would come in about 4.5 BCF per day lower than what we had during last winter's cold winter. So there's two other very important demand elements that need to be talked about when looking at the balance. One of those is gas that is exported to Mexico, and then we'll talk about what could be exported via LNG as early as this winter. Getting a handle on what goes out to Mexico can be challenging because not all pipelines that flow gas out of the United States to Mexico provide timely nomination data. So historically what we've done here at Genscape is we've taken a sample of the pipelines that do report interstate volumes, and then we've regressed those against the EIA data that gets reported 3 months later. Historically that actually has worked out pretty well for us up until this year. What happened this year is that there was the advent of the Net Mexico pipeline. This is a pipeline that is capable of flowing up to 2 BCF per day once it's fully in service. Right now, we estimate, and I'll tell you how we're estimating it, but right now we estimate that this is flowing well over a BCF per day out of Texas and into Mexico. Now, for Mexican exports flowing about 3 BCF per day, this Net Mexico pipeline itself represents a third of the volumes that are going across. So trying to get a real handle and a real-time estimate of what Net Mexico can flow into Mexico has been a very important priority for us. And what we've done is we've installed monitors near critical facilities, screenshots that you can see there on the left. And from that, we've been able to give real-time estimates that we can deliver to the marketplace for how much gas is flowing out of Texas into Mexico on the Net Mexico pipeline. And what you can see here is that that pipe has been flowing on average about 850 million cubic feet per day, with some days flowing as much as 1.2 BCF per day. And the reason I bring this up is because this does two very important things for our estimations for Mexico. Number one is it brings our sample up from about 78% to in excess of 90% of what's actually flowing. The other thing it does is it brings the correlation of our sample to EIA data up from a 0.88 to a 0.99 R-square. So with our data, you really don't have to guess anymore what's flowing across. You can use our data to get real-time estimates and reduce the error in your estimations. So with that data, we have adjusted our forecasts for what the United States will be exporting to Mexico, both this winter and longer term. This winter, we are expecting exports will average about 3.1 BCF per day. That would represent a 1.1 BCF per day increase over last winter. Not very much of a surprise considering that net Mexico itself is flowing pretty much close to those volumes. We do expect exports will peak sometime around March at about almost 3.5 BCF per day. And then as you can see with the chart on the right, we expect a pretty sustained upward trend in export growth to Mexico. We are basing this on the expectation of power plant development within Mexico. There are numerous power plants that have been proposed for development. In our forecast, we are only including power plants that have either broken ground or have been fully contracted by CFE or IPPs or individual power producers that are producing power for their own consumption. In other words, industrials that are producing power for their own manufacturing purposes. So we are only including plants that we feel have the likelihood to go forward, and then we're taking the next step and looking at the pipelines that serve those plants and only including flows on pipelines that have the likelihood of flowing. One of the things I do want to point out about this forecast is that there's certainly upside and downside risk to this. The downside risk to this forecast comes from the fact that the Mexican economy has been, a lot of this growth has been a product of a robust Mexican economy. Mexico's domestic gas production has been declining at the same time that its power demand has been growing. That power demand has been a product of a healthy economy. However, their economy is very much tied to crude oil. If the crude oil price remains relatively suppressed, there's questions about what that does to Mexican GDP growth, and if Mexican GDP growth gets threatened, what does that do to demand? So there is downside risk to this forecast, but I should also note that there's also some upside risk as well. With the recent trade deals that have been signed, or enhanced rather, with the United States and Mexico, many economists that we read have suggested that Mexico has somewhat of an advantage in providing finished manufactured goods into the United States relative to the rest of suppliers from the global market. So a lot of this forecast is really dependent on what happens with the Mexican economy going forward. And then the last the last demand component that I want to address is LNG exports. As many of you know, there has been a very big push in the last several years to address the U.S. supply glut by creating an LNG export economy. Right now, the one project that could potentially come into service as early as this winter is Sabine Pass. As you can see from the table on the bottom, we are forecasting that Sabine could come into service as early as January of 2016, albeit at a rate that's much lower than its ultimate capacity. But we do expect that Sabine will be flowing in this winter market. We think that over the average of the winter, we could be seeing about 120 MMCF per day of gas. Lots of questions as to the timing of when Sabine Pass does come into service. We know that they've made a request to FERC to begin supplying fuel gas to the terminal. And then shortly thereafter, we saw pipeline nominations on Creole Trail beginning to flow to Sabine Pass. But because there are so many questions about when Sabine is going to be flowing, we have put proprietary monitors on the facility. You can see screenshots there of two of those different monitors. So with these, we can not only provide construction updates for the facility, but we can also give updates as to real-time behavior for what's happening at the facility with facilities being turned on, and we can capture heat prints and use infrared imaging to tell you which LNG terminals are loading up and getting ready to export. Certainly you can combine this with our ship data to, once Sabine starts flowing, to get a real accurate estimation of when and where cargoes are going to flow. But nonetheless, this is a potential source of demand for this winter's market that should be built into our balances. So with that, where does that get us to with storage? Before I show you our end of season estimation, one other thing I want to point out with storage is that we are doing some proprietary monitoring on this front as well. We provide a daily estimate of the weekly storage number in our daily supply and demand model. That is taken from a balance of the lower 48 pipeline nominations, as well as a sample of nominations that go to storage facilities. But as many of you know, a lot of these storage facilities that are major market movers are rather opaque because they don't connect to pipelines that are required to post timely flow information. This problem is particularly acute in places like Texas and Michigan. What we figured out is that we have the ability to monitor key storage facilities. We started with Texas and have installed proprietary monitors on North Lansing, Markham, and Bammel. Those facilities alone give us a very accurate representation of what is happening within Texas intrastate storage on the whole. So again, as with Mexico, what we're doing here is we're taking out a lot of the guesswork by using proprietary data to provide transparency that's not available by just using pipeline nominations on their own. So with that in mind, we factor this into our estimations for storage. When we build that in with our supply and demand outlooks, we get to our estimations for where storage should end at the end of this winter. And what we are doing here is, again, we are giving you 3 different scenarios based on our different demand projections. So the first bar, shaded black, basically says that if demand this winter comes in at normal, then we would expect end of winter, March 31st inventories to finish at just above 1.5 TCF. That would be an 89 BCF increase over last winter's end of season inventory. And that's really, again, a product of the fact that although we are expecting production may start to show a decline this winter, overall, on the balance of the winter, we expect production to end up from last winter. Last winter was showing very radical production increases from the previous winter. So supply is, domestic production is still very much a big driver of this market. And as Randall noted, that supply could come on very quickly if the price signal is there. So a normal winter should leave storage inventories pretty much within, quote unquote, normal levels. What happens if temperatures replicate what we saw just 2 winters ago in 13-14? Well, if that's the case, then we would estimate storage to end at just over 1 TCF. And as you can see, when you compare that to winter of 13-14, again, that's at a surplus to what we saw there. Again, that's really a product of the fact that production continues to grow winter over winter. However, as I noted, most market consensus is forming around the fact that we're going to see an El Nino this winter. El Nino is generally bearish for demand, generating warmer than normal temperatures. So if we get a repeat of the temperatures that we saw in winter 11-12, then storage is likely to end just over 1.8 TCF. That would be a 0.4 TCF increase to last winter. However, I do want to note that that would be about a 0.6 deficit to where we ended winter 11-12. You can see that all the way over on the left side. And the reason for that is, yes, we have seen production growth, but we are far enough removed from winter 11-12 that there is substantially more demand, even under under extremely warm temperatures. We have a lot more demand in the market that could potentially prevent us from repeating the storage inventories that we saw at the end of that remarkably warm winter of 11-12. But really, the takeaway here is that in all 3 scenarios, we're looking at storage inventories at the end of winter 15-16 coming in pretty much within the normal bounds. So with that, I want to just provide, quickly summarize. On the supply side, we're looking at production coming in about 0.8 BCF per day above last winter. We expect production will probably climb up to a peak in December, but then decline and show fairly steady declines potentially until 2017. As Randall mentioned, the risk to that forecast could potentially be on the high side because of all of the volumes that have been choked back or shut in because prices in the current market just aren't strong enough. Obviously, if demand ticks up, that production is there and ready to come in and take advantage of strong higher prices if they manifest themselves. On the supply side, we do expect that imports from Canada will decline 1.1 BCF per day from last winter, but we also do expect that LNG will show up. Maybe not quite on the same level that we saw last winter, but more than we saw in the previous 2 winters. On the demand side, that structural growth that we've seen in both the ResCom and the power sectors should continue to generate more demand even under normal weather conditions. Certainly under extreme cold weather conditions, we would see even greater demand growth. But if weather does end up looking like most people are expecting, we should reasonably expect demand to come in lower than where we saw it last winter, possibly to the tune of about 4.5 BCF per day lower if we get a repeat of temperatures that we had in winter 11-12. And then rounding out the demand story is an expected increase of about 1 to 1.1 BCF per day to Mexico, as well as potential first exports of LNG from the Gulf Coast. But either way, regardless of the demand scenario, we do not see storage ending the winter anywhere at an extreme level outside the normal bounds that we've seen the last couple of winters. So with that, we'll take some questions. If anybody has any questions that do not get answered in this, please don't hesitate to reach out to myself or Randall. We will make these slides available after this presentation. But if you have any questions that you'd like us to address, please submit them now via the platform on the webinar. We will do our very best to answer as many as we can, given the time allotted. Give me just 1 minute to field these, and then we'll go ahead and start answering questions that have come in. So bear with us for 1 minute, please. Okay, so the first question pertains to one of the very first slides that we saw, asked about the table showing weekly injections. The question is, are the weekly injections your latest forecasts, and why do we expect larger injections with higher weather loads? And so the answer to that first part of that question, are these weekly injections our latest forecasts? The answer is yes. Those are our latest forecasts that you can see in our daily supply and demand report. Those were updated this morning, and our end of season inventory was also updated before this webinar based on today's EIA release value. The second part of the question, why do we expect larger injections with higher weather loads? And the answer to that is it's really twofold. One, October's kind of a weird shoulder season. You're kind of in this purgatory where you don't necessarily have robust heating load kicking in just yet, but at the same time, you're not necessarily seeing temperatures hot enough to justify cooling loads. So it's not uncommon to see injections throughout October. It's actually not uncommon to see injections in the very first parts of November. I think what is uncommon this year, however, in our forecast is the weather. And right now, we are not seeing any weather in our 14-day forecast that is anything to the colder side of extreme. In fact, our lower 48 weather forecasts made by our meteorologic team in Boston is showing substantially above normal temperatures for lower 48. There's below normal, or excuse me, I should say seasonal temperatures out east, but out west and in Texas and the Midwest, we are still seeing for the next 7 to 10 days above normal temperatures. That does start to shift back to a normal pattern. But really, the outlook for the rest of the month is for above normal temperatures, but not so above normal that were triggering cooling loads. And then also production. Our production continues to remain strong year over year, and that is keeping the balance long on supply, at least through November. So we'll look at the next question here in just 1 second. Okay, so we have a question. Hey, so Randall, this is a question for you. How did you determine the $1.50 per MMBTU price threshold for Northeast production shut-ins to decline and for production to come back up?
All right, I'll get that. Thanks, Rick. Basically, we built out economic models across all the basins, and we do an update every other month. We did our analysis on the Northeast and the Marcellus, and average operating costs are about $1.50 for that region in Northeast Pennsylvania. And the day we saw prices drop below there on the cash prices, we actually started seeing the shut-ins. The first time we saw that was December 24th of last year. We saw at half a BCF a day at the time. We've seen more as prices have gone lower. So $1.50 is kind of the first time we saw shut-ins, and that's the first time we think when it gets back above there, we'll see the production come back online. One thing I will mention is that these economics continue to come down as we did the Marcellus. Let's look at the dry gas, for example, in Northeast Pennsylvania. In January, when we did our analysis, we thought the break-even price was $2.91, assuming a 10% IRR. Since then, efficiencies have improved. Well costs have come down about 8% on average. Lateral lengths have increased by about 12%, which has improved the economics quite a bit, just those two hand in hand. And right now we think the break-even price in the Northeast Pennsylvania from a full cycle cost is about $2.31. So these numbers do change. As of now, we think that $1.50 is a level at which we see shut-ins. I see there's one more question on here actually asking about why isn't there more than what we're seeing currently if prices are lower than that. The reason is some companies can't handle shutting in. Some companies are tied to firm transportation and getting better pricing somewhere else. So if they're tied to that pricing and they can handle it, the producers will shut in, and that's why we've seen over a BCF a day shut in over the last few months.
Okay. I guess I'll take this next one, and then Randall, we've got a couple more for you, but I'll take this next one, and Randall, obviously chime in if you have any opinion, but the question is, what do we see for prices in Canadian markets like AECO and Dawn for this winter? I guess in both scenarios, rather bearish sentiment for AECO and Dawn. AECO because the production, Spring Rock obviously has longer-term production declining, but those production declines are rather gradual. And while we do continue to forecast demand growth up there, again, it's pretty gradual, it's pretty steady, and there's risks to that forecast as well. There's questions about the Alberta economy with the commodity price collapse. A lot of the demand growth that has been occurring up there has been a result of a pretty healthy economy because of the commodity rally for the past couple of years, as well as population growth, or rather population migration into the province. But overall, it's still a province that it's still a region. I should include BC into this. It's still a region where there's substantially more production than there is demand. Storage inventories up there are pretty healthy headed into the winter, and so the imperative for AECO and West Coast Station 2, for that matter, to price itself to flow its surplus gas into the U.S. and Eastern Canadian export markets, it's still very much there. The fact that it has become increasingly difficult for AECO gas to compete into the U.S. and now the Eastern Canadian market as well also creates added pressure on that AECO price. So not really seeing a whole lot of reason outside of anomalous extreme cold weather for the AECO price to really get bullish. And then going out to Dawn, moderately bearish out there. mostly because the availability of supply to Dawn has really been enhanced over the past couple of years. Dawn now has access to that Marcellus Utica gas by virtue of backhaul projects or new sort of reversals rather out of the Northeast. As I showed in that expansions chart, we've got another one coming this winter that will enable Marcellus gas to flow out of the Northeast into the Ontario market. Also with the Rex east to west reversal, you're just pushing more gas into the Midwest. The Midwest is a supplier of gas into the Dawn Ontario market. And so lots of reasons to see the supply side price that Dawn has to tap into holding steady, if not being pushed down. So really very, very little reasons for Dawn to have to rally much more than it has. Obviously, because there is no production in Ontario, Dawn will continue to have to feature a premium price relative to virtually every other market in the U.S., with the exception of Algonquin. Yeah, really, by virtue of having access to more and lower cost supply, Dawn should be in a pretty good position. And not to mention the fact that Dawn inventories are in storage are also entering the season at healthy levels. So we've got another question for Randall here. In just one second. Randall, we have a question. If U.S. oil production peaked in April at 9.6 million barrels, how much associated gas do you see declining in 2015 and 2016?
So right now, we actually believe that 2015 had still increasing associated gas production on a year-on-year basis. We are actually on a gross basis on decline right now, but we actually believe associated gas peaked a little bit after when oil peaked in April. That was mainly due to some areas in the Permian where we saw some flaring that was going on that is no longer being done. We've seen reduced flaring. For 2016, on a year-on-year basis, we actually think associated gas will be relatively flat because as we increased for the most part of this year, we're now on the decline. So when you're increasing in 2015, and then the decrease is about mirrored that on a slope basis for 2016. So really on average for 2016 will be flat year on year. If it weren't for all the efficiency gains and the deferred inventory this year also, then we would be declining a lot harder than we are.
Okay. I want to thank everybody for all the questions that have been coming in. We've been getting a lot. We're not going to be able to get to all of them today, but we'll take two more questions. Randall, there will be one more for you. I got a question, and again, feel free to opine on this. But the question, it seems as if it's impossible today to find a bullish case for natty gas. The question is, can we think of one? And, it can certainly go through scenarios. Looking at Randall and Spring Rock's production forecasts, showing declines on the supply side, in addition to anticipated declines in imports from Canada. You're looking at a scenario where production declines plus import declines kind of tighten up what we're seeing on the supply side. At the same time, we do have demand growth. So if those supply side declines actualize or exceed expectations, at the same time, if our demand expectations come in, or if demand comes in higher than our expectations, obviously you've got a tightening of the market. The demand piece is very intriguing because, as I mentioned, a lot of the growth is occurring in the power sector. When that happens in the winter market, you set up a situation for enhanced volatility because you've got power producers bidding for gas against ResCom. And we know that, utilities cannot turn the heat off on their consumers. And so you get certain markets in the past couple of years, primarily in New England and the Northeast, where the gas price gets bid up so much precisely because the utility/ResCom sector is bidding against power for that molecule that it absolutely must have. Power actually reaches a point where it can bow out of the stack and switch to some other fuel or just not bid into bid into the power stack. But we know that in markets like New England and parts of the Northeast, some of the price volatility and price rises that we see during the winter are a product of that of that rescom versus power dynamic. As our power load or power demand for gas in the wintertime increases, you certainly have the potential for that to exacerbate that dynamic. One of the things I do want to point out, though, is kind of hearkening back to what Randall said, which is, if you create so much price volatility to the point where you create a price signal, you do have these producers that have production available to sell into that market. And if that happens, then you do sort of take some of the steam out of those basis blowouts and out of that volatility. But certainly you can envision a scenario where the supply decrease coupled with the demand increase, maybe even potentially higher than expected exports to Mexico, could create bullish scenarios throughout the course of the winter. But over the long term, over the average of the entire winter, we're still looking at a relatively tepid market that's pretty well supplied. Let's go ahead and take one more question. And I do want to note, so this question's for Randall. I do want to note we received a large volume of questions. We are going to do our very best to reply to those folks, get those questions answered. So if you just give us a couple days, we will try our very best to answer all those questions. But for the last question, Randall, question about what is the backlog of the DUC wells, the drilled but uncompleted wells, and how fast do you see that backlog getting worked through?
All right, thanks, Rick. Yeah, most of the DUC that's out there has been in the Northeast right now. We think there's about 800 wells that are built up there that are abnormal, that normally wouldn't be there based on the current pad drilling that's going on. Most of the other DUC inventory in the associated gas plays we believe will be worked off by the end of this year, other than the Bakken, which the Bakken should probably hang around through next year. And just to be clear, when we look at deferred inventory, we look at the pad drilling sites and what's going on there, because in any kind of pad drilling operation, there's always going to be an inventory that's there. And you didn't hear much about it last year on the associated gas side, because when you were running a couple thousand rigs, and running an average pad size of 5 to 6 wells on each pad, you're going to always have a well inventory there. So if you're on your 6th well drilling, you're always going to have 5 wells in your inventory. So a lot of that inventory abnormally has been built up because the rig counts declined so fast that all those wells that normally were in this operation to go through and be completed at a certain point in time, once those rigs went away, they automatically kind of went to what we call an abnormal inventory and just needed completion crews to get over there and get to those. We think most of those, like I said, on the associated gas side will be worked out by the end of this year. On the Northeast side, I saw there was another question on here also about how long would it take to go through those. Like I said, we've added about 250 wells to that inventory since the end of last year. We think, based on where the pace they were completing wells last year, if you added the same amount of crews you had, it would probably take on the order of about 18 months to work through those once they decided to go through those. And that is where a majority of the production on the gas side is tied up, is in those DUCs in the Northeast. When you have 800 wells in your abnormal inventory, and say you're averaging 10 million a day per well, if you brought all those wells online at once, which won't happen, but if it did, you're talking on the order of 8 BCF a day of potential production just tied up in there. So what that really does is, if anything does start to get bullish, it really puts a cap on the upside of that bullishness, because you could see those wells being completed as quickly as possible. Great.
All right. As mentioned, we will do our very best to get to reply to those questions that we were not able to get to on the webinar. I also want to point out that we will be sending out a recording and the slides to participants tomorrow. Obviously, if you have any questions that you weren't able to get in, please feel free to reach out to Randall or myself. You can see our contact information there. Also, please check out our website there and get an overview of all the different products and services that we have to offer. But with that, we'll go ahead and wrap it up. I want to thank Randall and thank everybody for participating, and we look forward to talking to you all soon.